If anybody's there, let me know if you can hear me. Testing. Let's go which speaker it's going to. Let me see. Okay, good. Testing. Okay, looks like the mic is working. Okay, good. All right, I'm going to mute myself now. Just wanted to make sure that, yeah, no video, right? I haven't turned the video on yet. So you don't have to finish my dinner with me. But you see my little graphic, right? Good. Oh, I see. That comes on later. Okay. Oh, there's more stuff. Look at this. There's this cool stuff. Let's see what this looks like. Wow, all kinds of stuff. I'm looking at all the toys they have in this thing. Let me take a look. It was a great day. Yeah, both sides, right? I love to review and what to use as guidance of taking best advantage of days like today. Okay, that's a good question. And typically there aren't many days like today. We'll try to break that down. We'll try to break that down. And days like today, just the brief version, I will try to get into a little bit. I don't want to veer too much from the topic, but you guys know me by now that veering from the topic is my specialty. But all right, you dragged me into it. Let me. Okay, so this isn't officially starting, but we'll talk a little bit about today. Oh, is this still the positioning from that's tomorrow? Let me see if there's still leftover stuff from today. Okay. Okay, so how to take advantage or how to trade days like today. All right, let's start with this. Okay, so days like today, which aren't that often, we had this fishbone pattern. Negative gamma, positive gamma, all over the place. So that tells us a few things. That tells us that it's going to be a day like today. That tells us it's going to be a day like today. It tells us we're going to climb the ladders up and down. These are chutes and ladders. You know, we get above 6,800, we're going to climb up, and then we're going to get to 6,850. We're going to get stuck there. We're going to climb back down, and then we can bounce back up, and then we're going to climb back up here. Then we're going to have a Trump taco salad all the way at the end of the day, and then we go flying. So on days like today, there's a few things going on. One, understanding where the volatility was when we came in. We came in with a VIX 20. Okay, so all these puts, these customer long puts, are going to lose delta. Okay, so this is going to go from whatever it was, let's just say 30 delta, volatility goes down, a minus 30 delta goes down, let's just say to a 20 delta. At the same time, these customer short puts, market maker long, think of them as calls. So their delta is not going to go up as much, but just by the virtue of us moving and the change in volatility, that's going to push us up. So you have to kind of understand intuitively, you don't have to know like every little thing, how volatility is going to, the volatility is just going to affect the move at different spots. Now, the other tricky part, though, is we have these calls, let's say, were out of the money when they were bought. So whatever, let's just say they were 10 delta, 15 delta. But there was a lot more volatility in them. So there was a lot more movement in them. So when volatility comes down, these calls kind of lose some of their pull up based on the drop in volatility, but they gain because of the move up in delta. So it's kind of a dance. If just in theory of volatility wouldn't have gone down, it was vol up, spot up, then we would have flown and sliced through everything. But the takeaway is volatility is going down. We're going to get some kind of vol crush. Okay, think of it this way. I'm sure many of you have sold, I think, iron condors or something on a stock before earnings, right? When the volatility is expanded. Yes, how it's going to react at the positive and negative levels. And then you have to think at the same time how the aggregated levels are going to act. So this whole aggregated level, this whole semicircle here, or ellipse, whatever you want to call it, is going to storm down. Right, positive vol compression, negative vol expansion, exactly. And so with the deltas leaving, with the volatility drop, these calls, these positive, aren't going to have as much compression. And the negatives over here are going to lose delta, and that's going to, market makers are going to buy back their short, and that's going to also push us up. So all this whole thing is going to go, let's just say it was an aggregated, I mean, this was in the money, so that's a whole nother story. But let's just say this whole aggregated mess was a 50 delta. You added up all the deltas, so let's make up a number. And this was another 30 delta. So that many deltas times this many contracts. And once those deltas drop, even if spot doesn't move, just from the drop in volatility, market makers are going to be buying back their short hedges. That's going to push us up. The drop in volatility is going to make these customer short, market maker long, less compressive, easier to run through. Just like it's easier to run through them on the way down. Actually, no, that's not true. That's not true. It's easier to run through them both ways. That's not true. It'll actually make the levels work a little cleaner. It'll make these levels work a little cleaner. So you won't run through levels as clearly. Now, yeah, here's what I was going to say. Now, I'm imagining many of you have sold iron condors on a stock before earnings. Let's just say the expected move is 8%, and you're selling 12% out of the money iron condors or strangles. And then the stock can move up 5%, 6%, 8%, and you're still going to be profitable even on the short calls that you sold against it because of the volatility drop. So that's what's going to happen here. And that's going to just kind of release some of the compression of these. I was right. It's going to release some of the compression of these. And so between the fishbone pattern and the change in volatility, okay, so we know we're destined to go up. And then, of course, volatility went up and down today, so that made it, a little trickier. Now, the other thing is what happens with intraday flows. Now, I'm not sure which screenshots I put in. That's tomorrow. Okay, so here's the picture then at 10:47. When we went up to the top, remember we were stalling up here. We were stalling out up at the 68.75, 68.80. And look what happened to the ladder. We have a whole ladder here where people are buying and selling and buying and selling. So you can't really predict much here other than it's chutes and ladders. We're going to go up and down the ladder. The tails mean customers were long, dealers were short, more here, and then that got closed, and then there were more here, and this got closed. So you start seeing everything opening and closing, and that's where you kind of have to watch what's going on real time or as close as you can just to get a feel. But what you see right here is you see a zone, 68.75 and 60. This is like a 10:30, 11, whatever time it was. Right. Exactly. Exactly. And that level worked. And then we got repelled from this. We climbed the ladder down. I don't remember how far we went. We got a little volatility spike when I forgot what the headline news was. But the other thing is this. In the morning, my best friends sold like 6,000, whatever it was, put credit spreads here, making a nice solid wall if we should get down in that area. And so on a day like today, you just have to guess we're going to go up and down the ladder. Now, I forgot what this was. This is already after the close. That's tomorrow. Then I do remember that we bought that broken wing, that we broke that broken wing butterfly when we were kind of down here somewhere a little later in the day. Let me see if pulling up a chart will help us. Okay, so breath was strong today. Look at this, 80-20. Look at this crazy thing, 80-20. Oh, shit. Yeah, and it's tricky, man. You have to be on top of that every 10 minutes, 15 minutes, you know. Our boy here does an amazing job. I mean, I can't say enough about how valuable, invaluable all this stuff is. You know, but it's a lot to take in and digest. You see this here, because sometimes you might not notice it I might not notice it on the chart with the whippy lines, but when we look and we see whatever this call debit spread came in, okay, I know that that's there. Sometimes you'll notice it because it eats something up or another. So that's the other part of it. You know, it's tricky. It's tricky keeping track of all that. Okay, so let me re-switch gears. And let me figure out what I'm doing here. Okay, so there's two things I wanted to cover today, or maybe three. VIX decomposition a little bit, understanding what VIX is. Is this the one? No, that's not it. This the one. Where's my one with the yeah, I thought I had it. I thought I had everything. Oh, here it is. And this one. Now we're ready for VIX, right? Okay. So I did this over the weekend because when we were at the highs on Friday and last week, correlation was really low, or especially on Wednesday or Thursday, I forgot what day. And so I did this. I said, okay, let me do a little workshop on that. And I said, okay, I also had mentioned in December, I guess it was, the little thing on what VIX is. And since I've been using the decomposition index, I want to do that. So we're going to kind of mush everything together and see where we go. Okay. And so let's start with what VIX is. Let me understanding what a VIX option is. So VIX is a 30-day implied volatility index. It's not a tradable underlying. There is no VIX. NVIDIA is a tradable underlying. You can trade NVIDIA. SPX isn't really a tradable underlying. You can't buy SPX shares, but you can trade it against or hedge the options against E-mini futures. So it's kind of analogous with VIX and VIX futures. Okay. So before we get to that, let's get to what VIX actually is. And I mentioned this a number of times. What's VIX? VIX is take a strip of options, and it, if you go to the CBOE website somewhere, you'll have all this stuff in here, where you can get enough stuff to make you nauseous on the formulas and everything. I know I can't find. Okay. But what VIX is it's 30-day implied volatility. But so from today, go out 30 days exactly, and then take the Friday before 30 days from now, whatever date that would be. Let's just call it February 20-ish, right near February options expiration. Run the VIX calculation, which is weighted strip the prices of the variance to get the total variance priced into the options. Do that calculation for that strip of options that's before 30 days from now, and for the next one after 30 days from now, which will probably be the end of month expiration. So this VIX is kind of important. I know people don't say that it makes a difference, but I think it does. If we're taking VIX on a monthly expiration versus a random Friday where things are thin. In theory, it's not supposed to make a difference because of the shape of the curve, whatever. I think it does. But anyway. So that's what it's measuring. Calculation is variance swap style. CBOE combines option price or core strikes into an implied 30-day variance and converts it into annualized volatility. So remember, when you see volatility of 16, that's annualized. Volatility is always annualized, and then we bring it back down to a daily, and we know that 16 is roughly a 1% daily move. It's okay. Now, we won't get into variance swaps. We can't trade them as retail anyway, but basically a variance swap is, I suppose, institutions or somebody, not me, will buy or sell variance, like totally non-directional. I think that the variance will be more than this or less than this within this time frame. That's a variance swap. Combined option price, okay. But now the VIX isn't tradable. There is no spot VIX that you can buy or short like there is in NVIDIA. So even when VIX now, okay, so I put this in because when we think of expiration yesterday, for example, or yesterday, when we saw yesterday a VIX of 20, on expiration day, January 20th, whatever that wasn't saying the VIX for January 20th was 20. That was saying that the VIX 30 days from now was going to be 20. So VIX is always 30 days from now. The VIX contract is 30 days from now. And that's what everything is geared toward. And I wrote this up in December initially. So as of late December, VIX was 13.6. Okay, that was the market's assessment of 30-day forward volatility starting that day based on that variance strip. Now, look how clever these people were, because that same day when VIX was 13.6, the forward curve had VIX futures at 12.17. Back then, VIX was 13. And sure enough, where did we close? I don't know if it was exactly 20.17, but pretty damn close. Pretty impressive, if you ask me. So now, the next question is, we'll get to that in a minute. So how do you trade VIX with VIX options? Okay, so like I said, with 3 days left, a VIX future with 3 days left is not what the 3-day vol contract is, still a 30. As the date approaches, the futures must converge to the VIX settlement print. And that's SOQ, special opening quote. I used to trade UVXY. That's a whole nother wild animal. Yes, I look at it. I haven't in a while. Do you trade UVXY, or do you like have a relationship with it, so to speak, or you just sort of asking informationally? What I do with UVXY basically is when we have a crazy vol spike, sell either short the UVXY underlying or sell calls. You could also buy put ratios. Yeah, when they are inverse, right? We were almost inverse yesterday. Yes, today would have been a good day to sell it. I like VXX better. It's a little less of a wild animal than UVXY. I mean, yesterday we had as you remember, as I mentioned, my toss is more accurate than this, but yesterday, we had VIX 9-day above or equal to VIX. That's when we were either in slight backwardation or flat. That's not a bad time to sell UVXY. A good time to buy it is when the curve is when the Nike swoosh is very exaggerated, when the front is so much lower than the back. So with UVXY, I like to sell calls. I just sell UVXY calls, or short the UVXY underlying. But not that much. It's just kind of something I'll do for spice once in a while. So a quick word about the SOQ. And what the SOQ is, special opening quote. And there's this weird process. It's the kind of thing when you read about it, you understand it. Then when you walk away, you go, that's kind of crazy. So what the SOQ is, special opening quote. 9 o'clock, the market makers kind of guess where they think VIX is going to be based on calculating those SPX puts that would make up that variance for the 30 days, the Friday before and Friday afterwards. And they kind of like, it's almost like a poly market. They put in their numbers, and then that's the special opening quote. Now, sometimes that gets funky because when you're doing the whole strip, there might be like a 0 bid or a 10-cent bid for something out of the money and a dollar ask. So a lot of times that opening quote is just going to be off. And so it takes a while for it to settle out into something that even resembles what the actual VIX is going to be. And sometimes it takes only 5 or 10 minutes. Sometimes it could take a half hour. So you get extra craziness there, aside from the craziness of people putting on new positions, which we saw yesterday, which was why VIX was high. If we get, I'm jumping around, but let's just go back to this. VIX was way higher than it should have been based on how much VIX moved. And now, so VIX is a demand for puts, right? VIX is a demand for VIX options. It's the same calculation, but it's on VIX options. So people were demanding buying VIX options. I think a lot of that was part of the roll. It's expiring. They had a roll, whatever, if they were late to the party. So now look what happened. Went from 120 all the way down to 100. Remember, I'm pretty sure I said in the morning that we would do for a bounce. That's based on this. When we get, and he said, and it's always, it's not an absolute value number. It's kind of where it is in relation to itself. I wish I could give you a simple formula, but there is none, at least not that I know of. So anyway, let's get back to the course. Yeah, the VIX thing, that's, and there's so much little information and nuance packed into that thing. Okay, so here we are. Okay, the March options, whatever. Okay, your broker may display VIX 13 at the top of the option chain, but the Greeks in pricing are key to the future. So now let's take a quick look. Hold on. We don't want to see that. I think the VIX, the March VIX is around 22. Now the price are going to be funny because of badass afterwards. Okay, so no, it's probably around 21. What you're going to do, real simple, is look where the at the money, where the prices of the puts and the calls is roughly the same. $2 from here, it's pricing in a VIX in this range, a VIX of 20 or 22. I'd have to check it out. And so this is what you're trading. You're not trading 16 or 17. You're trading VIX 20. And if you bought a VIX 20 option, VIX would have to be 22 for you to break even. So it's kind of a sucker's game. It's kind of a sucker's game. That's why I always end up with these Frankenstein VIX things. So if I were to put on a VIX trade right now, say for March, and I have some VIX trades on. I just trade them a little bit. I like to get an extra 500 bucks or so. Okay. So we know that 22 is kind of what's priced in. And so let's just start off with something simple. $0.87. Not terrible. 87 cents. If we end up with VIX at 20, so 87 cents, let's call it VIX 18 is your break even. A VIX of 20 would be, would be $2. So 87 cents, you'd make $2 if you just held it to the end. Of course, if VIX expired above 22 on this date, then you'd start losing a little bit, but you wouldn't lose for another dollar or two till 24.25. So that would be a simple trade. Or you could kind of cowboy up and Frankenstein it up a little bit and go something like that. And just kind of play with the numbers a little bit. One for, now I don't mind having naked VIX short calls, but a lot of people do. So you could do something like this for just a 71-cent debit. Now you're good all the way up to here, but if it goes past it, past 25, now if it goes past it on a spike and comes back down, you have to be willing to sit through the fake pain. And so you can play around with it like that. A lot of people, or some people, like Z Contrarian, for example, and I did his trade and I showed it to you guys, might do a trade like this. For credit, or this. We can even go up to 30, you get a free trade. But VIX would have to be over 18.25 for you to get paid. And you'd have to, if VIX spiked up to 25, you'd be naked these calls and you'd have to think about it, or you could just throw something on here on top just so that you don't get totally killed. Something like that. And now it's already costing you too much because you're buying this crap up here. I like to sell this crap up here. Okay, so understanding, one of my main goals in presenting this was helping people understand what VIX is. Looks like it would today. Well, I'm going back to the random walk. I think the random walk for today was people's guesses were random because nobody knew what was going to happen. So you could look at it, that way. You're late, but you're here, and the recording will be here. I know Selena is the hardest working woman in show business. I don't know if you people know who James Brown is, but they used to say, James Brown, the hardest working man in show business. Okay, and so, you can do all kinds of things with these. Hold on, I really don't want to show this to few people because I don't want to get you guys to get in trouble, but I will. Okay. Yeah, I got out way too. I always get out way too early. I always get out way too early, but catching the meat of the move, even part of the meat, is good enough. Okay. So I don't know if you can see it. So here's my February Frankenstein fly. Small, $200, 80, but I don't think I paid anything for any of this. It was always buy one, sell two, buy one. On a day like today, the 39 call that I sold yesterday for whatever it was. Some of these I just sold yesterday when we were up. And now I'll buy them back, I'll roll them down, I'll buy this back for 94 cents, let's say, and sell something over here. Now, I've been trading in and out of this mess for how long? For how long? Let's see. I started putting this on 212 when the VIX was 13, 15. And I've been in and out of it. This only shows you what's here now. It doesn't show you what I've been in and out of. And so with all that, bought on 212 when VIX was, I don't know, we'll say 15-ish. The 15 VIX call is losing money. Even though VIX is up, whatever it is, how many points it's up, 5 points or 3 points since then. The at the money VIX call at that time would have been losing money. The only way you make money on this is, I think I probably did long one, short two. That looks like me. Free trade. I probably bought something further up, way out. Let's see. Yeah, same time, 12:19. Yeah, all this whole mess was done at the same time. I bought one call here at 25. And then probably the same day or the next day, I sold a call right below it at 24. And I'm just kind of constantly messing around with this. I had one of these for January. And I got one working for March. It's basically break even-y. And I haven't been messing with it too much. I'm just kind of building it out. Knowing that these long calls up here are money thrown in the toilet. This is money thrown in the toilet just so that if vol goes crazy, margin doesn't blow up to $20,000, $50,000. And you have to close out positions that are good because of margins. So you have to be careful for that. With VIX this high, I might be looking to add some stuff in here. We'll see. I might take that fly that I showed you for February and layer it in here with the idea that with a goal, with a view of where we're going to be in March, and that view is basically based on the option change somewhat. And where's the March VIX? The 3-month VIX is 19. So 1920. So, so I'm okay selling the 25. I'm sure that's okay selling the 30 or the 35. And, I don't mind, like I said, I don't mind. I'm not symmetrical here. I have more short than long, I'm pretty sure. So anyway, like I said, I really shouldn't show you guys that because you could get in trouble doing that if you're not sure what you're doing. Or if you just let lizard brain grab the mouse. Okay, so let me get back to where I was. Okay. Okay. I think that pretty much the 20 strike call isn't far. So based on that calculation, the 20 strike call was at the money at that time. Okay, so I understand. Okay, we did that. Module 4. Spot versus future. I think we already did this. I think I'm beating a dead horse. Okay, so term structure at that time was dramatic. Spot VIX was 13. The future, okay, we're back to that. That wasn't the market being wrong about spot. It was pricing a different time window. It was pricing the January time window. And out here's got some obvious stuff. Known events, FOMC, CPI, elections, whatever. When you have that 30-day forward window, depending where that window pushes, that's going to affect where the shape of the curve. And Spot Gamma does a good job on this. I put in one of his things. Where can how do I find it? I'll dig it up later. Where he takes the curve and then he zooms in and puts in the kinks where we have events. If you looked at the curve, you'd see we have a kink at the FOMC next week. We have a kink, a little kink at PCE for Friday. I put it in the Docs commentary before. Okay, so interpreting that 13.6, 6.5 cent premium suggests market expects Q1 to be more volatile, and they were right. Risk premium for uncertainty around Fed policy earnings or macro events, and they were right. A smaller 98-point step from January to March suggests slightly elevated risk going through Q1, but based significantly, March basically the same. And then I just go through kind of what I went through just now, giving examples. Let's see. But given explanation, find the strike with the same expiration, call and put prices are nearly equal. That approximates the future level. That's what I just showed you. So at that time, the 20 and 21 strike were about equal. That confirms that that's what you're really trading. VIX up, down, soon ideas. Okay, that's if you want to sell a near dated VIX and buy a further dated VIX. So I like doing the opposite. I haven't done it in a while, but another trick is something like, let's just look at this, for example, sell the March 25 and buy the February 25, 56 cents credit. That back one rolls off. Now, usually institutions do it kind of the other way. They would be, let's just say, buying the 20 and selling the Feb 20. And that's the roll. They're selling the roll. So they're paying 72 cents for that. And then you could turn that into a debit spread. There's lots of different ways. What's the question here? How does that work doing VIX that way? I'm not sure what you mean, how does that work? The indefinite article, that refers to something, and I'm not sure what the reference is. I put on my English teacher hat. Okay, we'll get back to that question when you can type it up a little more clearly so I know what you're referring to when you say that. Oh, this one here? How's that work? The VIX spread you gotta show the different dates. So that's a calendar spread. You could do it either way. So at the end at February, if VIX is below 20, this expires worthless, and you end up owning a VIX call, a March VIX 20 call, where your cost, your sunk cost would be 72. It's a calendar spread, exactly. Buying the calendar spread. Or if you want to be a cowboy like I like to be, because I don't like paying for anything, where I buy this and sell this, get a credit, but then I end up short this 20, but by then this will have hopefully receded, or you can go up to 25. Whoops. You don't have to do it straight. You could find something where you, and I would find a strike that works, but I don't mind doing the same strike. You like that idea for VIX? Yeah, that's a cute way to do it, and to have some kind of exposure. Yeah, okay. So I'm just giving you guys some different VIX ideas. Paper trade them, or trade them small, one contract, whatever, until you get the feel for them. I don't even do 10, 20 contracts. I'll do 3, 5, whatever. Try and squeeze an extra $500 out every expiration. Plus, during the week, I'm always buying back some of the VIX calls. Oh, I just made $112, and then sell another one here or there. I'm always messing with those. Okay. Now, I think we've pretty much covered most of the stuff. Yeah. Fade idea. Fade the January premium, so that's the spread. Curve flattening, long the 20, short the March, the calendar that we were just talking about. Thesis works, that the vol will compress, play the disconnect between the other one. The butterfly centered on 20, that would have been beautiful. That 20 would have expired exactly worthless. This would have cost you like pennies. Common trader misconception: VIX option price or VIX quote on the screen. They're not priced off the futures. I did good work on this, I have to say. Current example: VIX at 13.6, a trader might see 20 calls and say, those are way out of the money, cheap lottery tickets. Wrong. That what I said before, a VIX option expiring 3 days, the one that expired in January, wasn't tied to 3-day VIX. Misconception 3. VIX index looks at short-dated VIX options, and this is kind of restating the same thing. Putting it all together, I think I put it all together, so I'm not going to re-put it together. For options buyers, recognize that at that time you're paying 6 or 7 point premium over spot to play the January, March options. For option sellers, know the vol that you're selling. For spread traders, look at the difference between the spread, final framework, price, change of pricing. You guys have this PDF in there. So just remember, 23 to 37 days, constant maturity. VIX index today, 30 days future. VIX futures, tradable forward contracts, what your actual exposure would have been. Mental shift: when trading VIX options, ignore the spot price on your screen. I'm beating a dead horse. And that's basically the VIX course, and a more detailed version of this will be in the workshop webinar that I'm trying to put together, like the complete doc workshop that I keep adding modules to. It's going to be like 473,000 modules. And there's going to be a fee for that. Current subscribers will get like a big discount. It'll be every crazy idea I've ever had, and every little thing I put in docs and musings that you like glanced at and said, "What is he talking about?" What? Okay, yeah, and you passed over with a minimum of concern, coming back to haunt you in an organized manner or semi-organized manner. Okay. Now let's go to the VIX decomposition index, because that's a toy that I've been using more and more. And if you guys had been paying attention, if you were in the server in August, when the announcement came in from the CBOE that this thing was coming out, that's when they came out with this. VIX decom. You can go to the CBOE website. This is in the user links, whatever I call it in the Discord. You could download this white paper that explains it. It's 25 pages or something like that. You could shove it into ChatGPT and ask it to explain it to you, and ask ChatGPT as many questions as you want until you get it, so that you have a little better feel for it. It's somewhere in the Discord. I'll tag me and Richard is good at Market Lit's good at knowing what stuff is. The PDFs for this, I put in the Discord, I think in workshop. I'll make sure that these end up in education and or workshop and or both. If somebody reminds me. I think that they're ready, but poke around. I'll try to be more organized, but you got to take the good doc with the bad doc. Okay, so this is the VIX decomposition index. Okay, they didn't update it yet. And so when this paper came out, they had a webinar. The guy that developed this thing was giving it. I tried to go, but I didn't have a verified business Zoom name call stock market thing, so I couldn't get in. I'm going to make sure to get one so I can get in the next time. Yeah, I agree. Use ChatGPT, but it sometimes gets it wrong. You have to be really, 90% of the time it gets it right. Sometimes it gets it wrong. So if you see something that's saying, wait, that doesn't make sense. Explain to me, you said this, but then you said that. Huh? Or take what ChatGPT gave you and put it in Claude or Copilot or a free one you have laying around and say, hey, check this out. Check the logic on this. Does this make sense? Because sometimes they get it wrong. Not often. And something like this is straightforward because it's a paper. You're not asking it to do anything that somebody hasn't already done. You're not asking it to figure out something new. Okay? And so, VIX decomposition. Okay. As we know, VIX is not fear. It's expected move 30 days. We talked about that a million times. Okay. So when VIX moves, and that's what the decomposition index is telling us, VIX moved on the 20th to the 21st. However many points it moved whatever it moved from the 20th to the 21st today, it moved 3 points, 15%. Oh, this is the current one. Okay, we could do a live example. And the the 3 points that it moved, different parts of VIX moved. Now, actually, in the decomposition index, they break it down into about 20 little different tiny pieces, and these are the main pieces, and there's little pieces within the pieces. So what moved today? And then we'll talk. Then I'll go back to the paper and kind of, this is good. We can go back and forth. Sticky strike went down 1.3%. What's the sticky strike? And I might have it. Okay, I have a cheat sheet somewhere. I'll dig it up. I have a real simple cheat sheet somewhere. Okay, so the sticky strike is, okay, that's the first one, the expected slide. What VIX move, what should happen given what S&P did and the established skew. Okay, so VIX, S&P went up X amount, so you would expect calls and puts and everything to reprice based on how on the slide in the S&P. Imagine a ski slope tilted left, put side richer. When S&P drops 5%, like it actually did, you naturally slide down the slope at a steeper angle. Higher volatility automatically. When it rallies, you slide back up, lower volatility automatically. So example, at the money vol, this is an old ass example, 15.5. The out of the money VIX puts you down 2 points, that becomes a 22 vol. SPX drops 1%, you naturally slide partway down the 22 vol. So that slide is priced in. That's not a signal. That hasn't changed, you just slid down. If VIX rises by the expected amount through the SP level, nothing is happening. So the other day, when stuff was acting crazy, most of the move was because of the slide, the shift. So what happened today? Most of it was the sticky strike, and a big part of it was the parallel shift. I'll get to the parallel shift in a minute. Parallel shift is kind of almost a cousin of this. Whoops, over here. I have a different sheet that I break it down a little differently. Parallel shift, surface expansion, contraction. The entire volatility surface moves up or down across all strikes. So the whole surface, the calls, the puts, everything came down today after tail events, flash crash, the Japan thing we had yesterday with the bonds. So yesterday, we don't know what this means. Everything went up. All the vol went up, the puts, the calls, everything. The whole thing shifted up as we went down. And then today, post earnings or post the Japan yield, post Greenland. We're not invading Greenland after all. Like anybody really thought we were invading Greenland, you had to be nuts. Once the uncertainty comes out, the whole thing, the whole shape of the curve flattens out. Okay, so they give this example in the video, and there's a good video. I think I put the video in the post I sent out on the weekend. If not, you can Google it or whatever it's. Chem Carson, Chemkarsan. I think most of you probably know him or follow him. he did an interview with Mandy Sue. Mandy Sue is the one who writes the weekly, she's like basically the face of the CBOE. She's the one that goes on TV and is a spokesperson whenever there's like webinars or stuff. When people come, she's always the host. She's kind of the face of the CBOE. And so you actually, if you look in the Discord, for example, if we look in the Discord under research, where is it? Random research or something, because I don't always research. Okay. Macro volatility index, that's hers. That's Mandy Sue. Macro volatility index. I don't always put it in. Sometimes I forget. You can sign up for CVOE. They email it to you. Nothing special. And you read it. You skim through it, whatever. A lot of it, like when they're talking about gold volatility or, different bond volatility, I might just glance at that. I look at the SPX stuff and the VIX stuff. So yeah, okay, so Kim Carson interviews her and they go through each of these. The explanation, I don't remember how good of a job they do explaining it because I didn't really watch it. I just skimmed through it because a lot of what they did was they went through the paper. And I already read the paper more than once, so I don't need him to interview her to tell me about the paper that I already read a couple times. I prefer reading to watching videos. I know a lot of people like to watch videos. Everybody tells me that I should do my PDFs, I should do videos. People like videos. I guess my era, we went to school, we read books, we read what they wrote on the blackboard. I learned to consume written content very efficiently. I can linger over stuff that I have to think over. I can breeze through stuff that's like, duh, that's obvious. On a video, I got to rewind it, whatever. Videos. So I like to read. Anyway, that's me. So parallel shift, we talked about that. So real world case, what happened? The yen carry trade in August last year, and the little echo we had yesterday, which was more the yen carry trade, 6 standard deviations on the yen than it was Trump Greenland, but Trump Greenland was in there too. So we had a double and we had a triple because we had VIX, and so we were having a party in the vol space. So the whole service expanded 5 or 7 vol points across the board. The Trump tariff announcement, different type of event, different structure of the shift. The shift was different. I'm gonna get to that. Okay. All hills on the ski slope grow taller at the same time. The relative shape skew stays the same, but everything costs more. So one end, the tail or the put tail or the call tail, whatever, that doesn't change its shape. The shape stays the same, everything just moves. Parallel shift, event passes, fear subsides, everything just comes back down. Okay. Downside bid. 2 days ago, and if I didn't put the VIX CBOE thing in the note today. I only have a certain amount of time. Well, hold on. I'm going to take this call for 1 second. I'm going to tell him I'm going to call him back. You know how you try and keep in touch with people and you say, I'm going to call you, and you want to call them every week or every month or whatever. There's a buddy of mine who we haven't spoke probably in a month or 2 months. So he goes call. I said, okay, you're calling for your quarterly check-in. I kind of mentor him a little bit in different stuff. When you get old, you mentor people and shit. You have friends, but you kind of mentor them. Anyway, classical bid fear, and so what happened? The put skew down. Okay, so the fear bid went down, call skew went up. Oh, people bought people. So here's the shift in the skew. The skew shifted down, so the shape of the slope changed. Yeah, good to check on your people, 100%. Yeah, I check on people. I do that. He just checked on 2 people over the weekend. I'm not great at it. I have some friends that are great. I have this one friend, Calvin. He calls me every once in a while. I mean, I've known him for 25 years. And he's just calling to tell you I love you. There's nothing you can do about it. And then we talk about what's going on in our lives with our relationships or finances or, finance romance or just like internal stuff. He was telling me about his relationship with his daughter, whatever. I was talking about what's going on in my relationship with Rachel, whatever. About the dogs, doesn't really matter what. Anyway, so yes, getting back to the task at hand. So we went through these. So this is what happened today. Put skew. Put skew went down. People aren't paying up for puts. Call skew went up. Call skew went up. People, the shape of the curve tilted up on the call side. Little bit. Okay, we're gonna get back to this. We're gonna go through it piece by piece. So when you see me post these in the notes, I'm usually, when I even remember to post it, and I try to post it every day, at least in Doc's commentary, at least a summary. It just becomes so much to post and so much to explain all the time. Hopefully, you'll begin checking this stuff. Just glance at it. Just see if you see something funny. And if VIX is going from 16 one day to 16 and a half the other day to 15 and a half one day is 17, it's not as critical to check it, although I like to, as when there's big changes. But it helps for the zero DT or short term. It's really important to know what's going on in the VIX pricing. Anyway, downside big, classical fear. Broken into 2 parts, the near the money and the out of the money, 2 standard deviations. Yeah, call skew, yes, he did. Now he saw that. Now, good. Now, vol trader saw that without this. And if you see what he has his own stuff where he downloads the data from wherever. I don't think he buys it anywhere. You could download VIX option chains and run it through spreadsheets and whatever. Like he's a former market maker in Europe, so he's used to doing that. When I first met him, I met him in in Gamma Edge. I'm pretty sure that's where it was, and everybody's talking about Gamma, and he's talking about skew. He's always talking about skew. And I knew that I've known that skew was important. I still look at Gamma more than I look at skew, but he was always talking about skew, and people were like getting tired of him talking about skew. It's kind of funny. Who else talked about skew a lot? Alma. I don't know how many of you follow my girl Alma. Interesting backstory with Alma. If you don't follow her, lately she hasn't been doing the stuff that she's been doing has been a little bit more esoteric. If you don't follow Alma, Alma's a good follow. I'm going to tell her. I'm doing a webinar with my subscribers talking about skew. So I love you and to follow. You can subscribe to a Substack, also the free one if you don't want to do the pay one. That's out. It's actually after, well, I'm going to not get into stories. Let me get back to work. I can go off the. That's on the long learning list. Okay. So what skew is? Okay. Let me try to at least give you an idea. Because I think once you have the basic idea, it'll start to make more sense. Okay. Skew oversimplified, but not really basics because you can complicate. Like a friend of mine was talking about another friend of mine who was building a fence. He said he can complicate a box of rocks. The guy's always building and he's the angle of this. Anyway, so skew. Let's talk about skew. I'm just going to randomly go over here. Now let's look at the 25 delta put. And the 25 delta was 50. So what's the 25 delta call? $25 delta call. So this put is that much more expensive than the call. That's the skew. The difference between, that's one way to look at it. The 25 delta put versus 25 delta call. But in reality, as you're doing intraday trading, this option, the 14 delta call might be more expensive or less expensive than this. So it's a difference between equivalent deltas. And normally the puts are more expensive. So it's by how much the difference is. And sometimes you might see more skew on a given option. So people maybe are going to be buying, let's just say, the 6,700 call. So that, well, not for January 22nd. Let's just, again, kind of semi-randomly go out here. Oh, good, 22 delta, perfect. And so the 22 delta call I'm just doing a shot in the dark here, and the 22 delta put. We're just going to say, are people buying this call more than the others? The pricing difference actually looks like, hard to tell, but you can look at option depth and see. But when there's a demand for a call, they'll bid it up. There might be more skew on one strike than another strike. or this strike might be proportionally more expensive than it should be from this strike. Oh, who did Spot Gamma do it with? With Mandy Sue or somebody else? Was it, I was a beta for Spot Gamma too. I still subscribe. I I might hardly ever read it anymore. I find that I I read other people's stuff less and less because I don't want it to color my view. If I have time, I'll look afterwards, see if I missed something, but I don't want it to interfere with my analysis by implanting an idea in my head, so to speak. False memory syndrome. But I start off reading them all the time and then coming up with my own stuff. It's all the time. Anyway, so that's skew. So you have a basic idea now. So skew is the difference in the pricing between puts and calls, how expensive they are. And there's a normal range where puts are, how much more expensive puts are than calls. And you probably have it. Thank you. Thank you, Sammy. I know you're in Bear Trap, I think, Selena. I'm pretty sure I know they have all kinds of skew charts in there. So you can kind of look at that, maybe ask preferred user or some of those guys. I don't think Kirby is there anymore. Vic is the other one. I'm not sure who else the people are there. I used to hang out there, do live voice there all the time at one point. Not how to apply it. Okay. Okay, so you have the concept. So we go. Your trick in life in general is going from understanding to application. First, you need to understand that you can't apply what you don't understand, although sometimes you can intuitively, but generally understanding application or intuition, you see something, then you go back and understand it, then you learn to reapply it better. There are two different ways. You're welcome. Okay, so let's get back to the thingy. Okay. Okay, so the classic fear thing, downside bid. And again, we'll go back to my vol dashboard. Sometimes that's depending what's going on. I might put, and these are TDEX and SDEX. TDEX is the 3 standard deviation out of the money SPY, not SPX puts. And there's kind of a, well, whatever. I think SPX puts tell us more about institutions. This tells us more about retail. And so look at this. Tuesday, they were bidding up the 3 standard deviation puts, the 5, 10 delta wings, whatever it was. You were sold that, sold those out of the money puts, and volatility collapsed in those. So from 20, so we started at 15 on Friday, whatever day it was. We went to 20 with round trip. That's the tails. And then SDEX, which is 1 standard deviation out of the money, elemental P, come on, alphabetical order, where are you? SDEX over here. Similar round trip, but not as dramatic. From 20 to 15 is much more dramatic than from 60 to 65 to 62. Oh, Matt Cashman, yes, okay. Thank you. I get notifications in the mail all the time of his videos, and I say, oh, I got to watch that one. And of course, I never do. Not of course. And I haven't watched one of his in months. And he does good stuff at Imran, and when him and Imran do stuff, They do good stuff. Imran and I were bantering about a year or so ago about doing some kind of service or something together. But he does gamma with spot gamma, so he didn't want to do gamma with me. We couldn't really think of something else to do, and so we didn't do anything. He's a smart guy. Anyway, so here's SNX. Okay, so he knows he knows a lot more. I've learned a lot from him. Okay, Liberation Day. Okay, so where are we? Upside bid, counter. Okay, so we just talked about the out of the money, the tail bid, and we saw what happened. We looked at SDAX, so here we can just see how much of this drop was because put skew went down. And then the last part is downside convexity, the shape of the slope. Now, let's talk about this real quick, and then I'll go around to the written material where I explain it a little bit. So wait a minute, Doc. Call skew went up, but upside convexity went down. What does that mean? Well, the skew, the difference between the call and the puts went up, and there was demand for calls, but the upside convexity went down. Why? Because volatility goes down, convexity goes down. Volatility is the standard deviation of the expected move over time. Volatility goes down, expected move goes down, the convexity goes down. Yeah, both Breath and MI, they're excellent. Yeah, and they're good teachers. They're good teachers too. So let's get back to this. Right. Oh, we did that one here, decomposition. Okay. Okay, so upside bid, call speculation. And so there we had so the convexity went down because of volatility. We saw that in the last item, but upside bid because people were buying calls. And he has call decks, what's his name? Scott Nations. And in my video archive somewhere, we did an interview with Scott Nations, another good guy. Shit, that was back in April, maybe, or May or June, a few, 9 months ago. And I have the video. I'm pretty sure I uploaded it on YouTube, if I even know how to do that. But anyway, yeah, and calls won't move as much, exactly. Upside bid. Okay, then there's, of course, the spot up, vol up, VIX rises during a rally. And that happens 20% of the time. So spot up, vol up is not as unusual as you think, or as people think. You can't just say, oh, VIX is going up, so it means we're going to go down. That ain't true. 80% of the time it's true. So you'll be right. More often you'll be wrong, but you have to, when this happens, post-Fed cut, Santa Claus rally, big stock earnings, calls rip through. Okay, analogy. Momentum traders mob the call counter. I want the rally. So many buyers that dealers can't supply, right? Dealers have to sell them. They don't have them. They have to sell them. They have to make them. So they start charging more for them. Dealers are short the calls. So when it does rally, they're forced to buy more, accelerating the move. We know that, negative gamma. For traders trading, watch VIX up, spot up, dead giveaway of call buying. This is often a high confidence signal that a reversal is brewing. Why? because if the market was sure that the rally was sure about the rally, put buyers wouldn't exist. Dealers are mechanically short calls. They need to sell into strength. Okay, timing. If upside bid is a driver, VIX stops fast, 2 to 3 hours. Then reverses as dealers unwind, and we see that a lot too. We see suddenly we're going up. We see on FOMC days, whatever. We're going up. They're chasing. Then suddenly the buyers stop, and suddenly the bid unwinds, and we go down the other way. VIX is rising, mostly upside bid. Your VIX calls outperform SPX puts. Why? Because dealer short gamma will reverse hard. VIX spikes on the next dip. The skew shift, the last part. What is it? Relatively pricing of puts versus call, independent of the surface, independent of what's going on. So skew can steepen, puts can get richer, and calls can get cheaper, risk off. It can flatten, calls get richer, puts get cheaper, rich on, invert. Really, calls get richer than puts, extreme complacency. You see that sometimes, like last year, we would see you before NVIDIA earnings, GameStop, you would see that. Okay, so again, we'll have to go back to August. Analogy, skew shift, narrative repricing. We were hedged, but the hedge didn't work, buy more puts. Skew of the events past were stayed, sell the puts, flatten skew. Case study, we're not going to go back to August again. Trump tariff wars, more case studies. And these case studies are out of the video. Okay. Reflexive lane, how dealer hedging amplifies move. Most important concept to understand. Okay. Hedger buys puts, institution, whatever. Wait. No, this I have to check this. I think I might have written it wrong. Hedger buys puts, dealer gets long, dealer is short puts, hedge is selling calls. Now this is wrong. I have to rewrite this. I gotta rewrite this. Son of a bitch. Practical takeaway. Yep, that's right. I gotta rewrite that. Son of a bitch. I thought I had proofread it. I got sloppy. When I'm typing in my little things and getting a ChatGPT or Claude to type it out with my typos and with my whatever, it gets it wrong sometimes. See, this is what I was telling you, it gets it wrong. Iron conduit trade, it's ridiculous mistake. VIX is 15. It's at the floor, time to sell out of the money spreads. Check, is skew normal? So normally the put side is going to be 1.5 to 2 times the call side. If skew is flat, calls are cheap, calls are trapped. Sell wider or further away. And who was it? Charlie, in the Moore's note, he said that call skew, not the difference, but the percentile, how different it is like in the 1% to 5%. Calls are very cheap relative to puts right now, or at least they were this morning. I'm not sure about right now. Spec is surface normal, or is there a bid? If vol is compressed, vol going nowhere down, max pressure is squeezing going up. Sell premium away from concentration. Okay, I think we know that. Put gamma delta hedging. So, you shorter clients, call spread, how do you hedge? So I think we know this. You shorter clients, call spread. So market makers are short. Is VIX up from downside bid or upside bid? If downside bid skew staying steep, call staying cheap, hedge by selling puts. Yeah, this is some market maker shit that I have to check this out. I think I have to revisit this. So I'm not gonna. I've heard Jem Carson talk about this, and I've heard people push back on that they don't always do it that way. So we're gonna skip over this. I want to double check this. And there's historical playbook. And whatever, okay. There's 2-minute drill, check decomposition, ask is downside bid. And here's like you even got my little video of how I was supposed to do it. We case by case, slide study with charts, but I didn't do it. White paper, okay, that you go to the website, you download the white paper, the podcasts, the one I just told you about. And Tom is the guy that actually developed it, Ed Tom. And that's where they talk about 26 minutes to 42 minutes in. Key takeaway, summary. VIX is 5 things, not 1 thing. Decompose it. Same VIX level, different compositions, wildly different things. August versus April. And it would pay to go through and watch the video just to see how the different parts of the skew are priced. Okay, downside bid hedging, dealers support downside, sell calls. SP outperforms. Yeah, I'm not sure about that. I'm really not sure about that. I know I read it, I put it in there, but I gotta double check that. Okay, so anyway, that's it. Grain of salt on that last part. I mean, I know that's what happens, they say, but I gotta double check that. I need to do a deep dive into that. Stay tuned for that. And we didn't get to dispersion. We'll get to that next time. And we know VIX isn't a stock. We talked about that already. Okay. We've gone for an hour and a half. Any questions before we wrap up? Q&A, come on, where is it? Media assets. Any questions? Let me see. Okay. I don't see anyone. Okay, going. And I guess we could say that's a wrap. Okay, everybody, thanks a lot. And I will see you tomorrow. I'm going to go feed the ducks. Called feeding the ducks. That doesn't sound like feeding ducks, does it? I guess it's ducks quacking. Going off into space. I have these little acoustic things here. Okay, I'm gonna stop torturing you guys with this. Oh, all of a sudden I got comments. You're welcome. Great workshop. Thank you, everyone. Some questions here. Good night, everyone. Thanks, Doc. Signing off. Talk to you on Discord later. Okay. Goodbye, everybody. Thanks a lot. That was fun. I enjoyed doing this. I'm glad you guys got something out of it. And I'll see you in the room. Take care.